Hey there, it's Howard Kessler with another in our free series of how to succeed in the financial markets. And this particular guide is going to show you how to make money in trading binary options. Now, in the first few chapters of this program, we're going to deal with the ins and outs of binary options. And we'll go into more strategies and software and very specifics in how to achieve success in trading binaries soon, but I wanted to actually cover the basics. So, well, first of all, what are binary options? Well, sometimes they're referred to as fixed return options, all or nothing options. Binary option is essentially a prediction of which direction the price of an asset, whether it's a stock or a commodity or an index or whatever currency, will move by a specific expiration time. Okay, so you're not actually buying the asset. You're not buying any stocks. You're not buying commodities or anything. You are actually just predicting whether that asset is going to go up or down in a specific amount of time. So there's actually, because there's only two outcomes, you're either in the money or out of the money. That's why it's called binary. Right? I mean, that makes sense, yes. Okay, so and you should also know that the price of the asset itself isn't important. The only thing that matters here is whether your prediction is correct or incorrect. Okay. Now, a binary options trade usually involves three steps. First is you choose a trade expiration time, and it could be a minute, could be 15 minutes, could be a day, could be a week. Usually it's within a day. Second is you choose whether that stock is going to go up or down, whether it's going to be a sale or a buy, call or a put. So if you think that the price is going to end up above the current price, for instance, then you would click the buy button or the call button. And if you think the price is going to end up below the current price, then you would click the put button and sell button. Now, once the trade is actually in place, then you just wait for that minute or 15 minutes or a day or a week. And if you are, if the, excuse me, I swallowed a bug. If the trade expires in the money, then, or as predicted, then you make a profit. And if it expires out of the money, then you lose. So that's where binary comes from. It stresses the fact that there are just two options in a binary option, two outcomes, and both of which are set and understood by the investor before you place the trade. See, now that's where it's very different from, say, buying a stock. If you were to buy shares of Apple Computer, you may own the stock, but then it could go way up, it could go way down, you could lose everything. If let me give you a specific example. Okay, if you were to purchase an Apple binary option, and say the option was for $100, and you were of the opinion that within 2 hours, Apple's share would be higher than they currently are, and if you are correct, and you get a previously set percentage return, which might be about, it averages about 85%. So you're going to get your $100 back plus $85. Now, should the shares go lower, and you thought they would go higher, then you are out of the money and you will lose that $100. But it's a fixed amount, right? You knew you were at most going to lose $100, but you had the option, the opportunity to gain $85. So it's good. It's a fair proposition because you know in advance what the parameters are. Now, a number of factors distinguish binary options from regular stock options, as I was saying. Typically, the short-run expiration means really that you can make an immediate profit on binary options, and they're way more versatile in their opinion, in their option investments, and we'll get into that in a bit. It's a little complicated, but in a regular stock option, a trader will pay per contract. Okay, so the investor might profit and might lose a sum based on the quantity of points difference between the expiration level and the strike point. too much. In contrast to binary options, which there's only two outcomes and they're set from the beginning. Okay, so an investor in a binary option, you just got to hold on to your option until the expiry date. That's basically the rules. Okay, you have to take more care when you're buying this because you're in basically for that amount. Now, that said, you can chicken out and basically pay your way out of the thing with. But that's for another video. That's where it gets kind of complicated. The simple thing to know is that you've got a fixed amount that you can win, a fixed amount that you can lose. Now, while all this is going on, and it's very simple from the investor standpoint, in order to make this work, there's a lot of math going on underneath the whole thing. It's really, really complicated. And before there were computers, digital options weren't even, well, obviously digital options, but binary options were not possible. It was just way too complicated to make this happen. But now it's all run by machines. And for years, binary options were only traded by large institutions and their clients. But this is the cool part, in 2008, I think 2008, the Securities and Exchange Commission in the United States approved the listing of binary options with continuous quotations, and now binary options are available to individual investors like yourself and like me. So most binary tracings these days are done online through private brokers that use really sophisticated trading platforms, and we'll get into recommendations of brokers and what to look for and what kind of systems they have and what kind of software they have, and the software that you can use to make your decisions smarter and sometimes just even automated. So we'll get into some of those things in the upcoming videos. For now, thanks for hearing me